Investors are rushing to the safety of money market funds, swelling the money market to a record $4.8 trillion, with $283 billion deposited in March alone. With stocks looking shaky at best, that 4.6% yield on a money market fund does look attractive against an average dividend yield of just 1.7% for stocks. But instead of giving up all that upside return potential and locking in a return that is still below inflation, I've found 7 dividend stocks that will put that same cash yield in your pocket plus the upside return, all with the safety you need. I'll show you the dividend screen I used to find these later, but let's get started with Advanced Auto Parts, ticker AAP, and its 4.9% dividend yield. Advance has over 4,700 stores in North America, with 1,300 CarQuest branded stores in Mexico and the Caribbean. Not only has Advance grown its dividend from just 6 cents to $1.50 per share for a 90% annual growth over the last 5 years, but I did some research last year into the stocks that hold up best during a recession. Of the 500 stocks in the S&P 500, just 8 of them produced positive returns when the stock market crashed in 2008. Among those, Advanced Auto Parts. Because when people start worrying about the economy and their jobs, they're going to fix up their old cars instead of buying new ones, and that's going to mean stable cash flows for auto parts stores. So not only do you get a dividend yield here well above the money market rates, but also a stock with an anti-cyclical boost, protecting your money from a market crash. Now, earnings are expected a little lower this year to $10.67 a share, but that still covers the dividend of $6 per year, and we could see some strong price returns as the company cuts costs over the next few years. Shares trade for just 14 times earnings right now, a 35% discount to the 5-year average valuation. Analysts have a price target of $150 per share over the next year. Now, as a warning though, this may not be a long-term stock pick, as a major risk is coming from the growth in electric vehicles. You see, EV cars just have fewer moving parts and even fewer that do-it-yourselfers can fix. That could mean less demand for auto parts and the industry in the future. It's hard to get any safer than this next stock, Prudential Financial, ticker PRU, with its 6% yield and 15 straight years of increasing dividend payments. In fact, I recently highlighted Prudential as one of the safest stocks in the market in our Perfect Dividend Portfolio series. And cash flows in life insurance are extremely predictable, helping to kind of smooth out the volatility in the company's investment management and retirement annuity segments. And while the U.S. represents 60% of revenue, Prudential is a market leader in Japan and has a strong presence in Brazil with 39% of earnings internationally, so you've got some solid diversification and some growth in emerging markets. And of course, shares have fallen along with everything in the financial sector on worries of those falling bond values in the fixed income portfolio, but Prudential has all the liquidity it needs to push through and maintain that dividend. Beyond the $1.8 billion in dividends paid last year, the company paid back $1.1 billion in debt and still had enough free cash flow to buy back over $2.5 billion in shares. That means it's generating all the cash flow it needs, and Prudential has grown that dividend by 6% annually over the last 5 years. The sell-off has brought the shares down to just 8 times on a PE basis, half the price multiple it traded for over the last 5 years. We'll get back to our dividend stock list, but I do want to show you how I found these, as well as warn investors on those money market funds that have been so popular lately. For this list, I filtered only for those stocks with a 4.6% yield or higher, getting you that money market yield or more. That way, you get the same cash return you get from the money markets, but then I also screened for dividend growth and long-term price return. From there, I narrowed this list down to the 7 with a safer outlook, themes and trends that I think are going to make for stable cash flows and returns. And nation, with that surge to almost $5 trillion in money market funds, I feel like a lot of investors may not understand the risks here. These are not guaranteed safe investments. Understand that money market accounts you open with a bank, those are insured by the FDIC, but those money market funds that a lot of people are buying into, those are not. In fact, the collapse of the several money market funds in 2008, that helped drive that financial crisis and almost caused another one during the pandemic if the Fed hadn't bailed them out. So along with these dividend stocks, instead of those money market funds, I did a video on the Treasury ladder strategy that I'm using, a strategy that pays even higher yields, but is 100% guaranteed by the government. So look for that link in the video description below. This next dividend stock is going to be a little controversial, with Altria Group, ticker MO, with its 8.4% yield and 53 years of consecutive dividend increases. I know some of you don't invest in those vice stocks like tobacco, gambling, or firearms, but that dividend yield and the history are hard to pass up when it comes to safe cash flow. The owner of Marlboro brand in the United States is driving hard to a smoke-free future with heated tobacco and pouch products, and has been able to keep up its revenue consistent despite a years-long trend in lower cigarette volume. You see here, even against an annual drop of 4% in cigarette volumes, the company has been able to stem that to just 1.7% on growth in e-vapor and oral products. Altria also owns a 10% stake in beer maker Anheuser-Busch, worth $10 billion for some serious cash flow. Even on that continued drop in volume, Altria had the pricing power and the cash flow to pay down $1.1 billion in debt, still buy back $2.1 billion in shares, and pay its $6.4 billion in dividends. Shares here trade for 14 times on a price-to-earnings basis, the cheapest it's been since 2018, for some upside return potential on top of that dividend. One of my favorite stocks here with Kinder Morgan, ticker KMI, and its 6.3% dividend yield and a unique exposure for energy pipelines. And Kinder is the largest energy infrastructure company in the S&P 500 with over 82,000 miles of pipeline, 140 export terminals, and a growing energy transition pipeline. You see in the business mix scale on the bottom here, the company is more heavily focused on natural gas than most energy companies. That could be a big upside as nat gas or LNG exports increase over the next few years. The price of natural gas is 5 times higher in Europe and Asia than it is here in the United States, and companies are going to be making billions exporting it. And what a lot of investors like about KMI is it offers the opportunity to invest in these energy pipelines, the terminals and storage facilities, but without having to deal with those K-1 tax forms that come with those master limited partnerships, the MLPs. KMI is a corporation, so it operates just like any stock. Kinder is aggressively building out its alternative energy business with renewable natural gas and carbon reduction assets. This is going to help it transition from oil and coal, but could mean higher capital expenditures and lower cash flow in the near term. As the chart here says, energy transitions take time, but that's only going to mean that its strong assets in fossil fuels will continue to generate profits for decades to come. More than 13% of the company is owned by management, most of that over 10% by founder Rich Kinder himself. The company has grown its dividend by 7% annually over the last 5 years and produces $3.3 billion in free cash flow each year. We'll get back to our list of dividend stocks, but I also want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign-up link below. Now I know it's going to sound odd putting a bank stock on a list of safe dividend stocks, but US Bancorp, ticker USB, offers a 5% yield and safety after the crash. USB lost as much as 27% of its value in that bank crisis, but not only is this the largest regional bank in the United States, but also the 5th largest bank overall by deposits, with over $570 billion in domestic assets. That size and nationwide exposure gives it the financial strength to not only survive, but to grow its deposit base at the expense of some of its smaller regional bank rivals. USB has always produced some of the best returns in the industry, with a 23% return on tangible common equity, dwarfing the 15% return on Bank of America and even the 20% return on tangible at JP Morgan. The bank has grown the dividend by 10% annually over the last 5 years, and with a payout ratio of just 43%, it can keep up that pace into the future. This sell-off has taken the shares down to just 6.6 times earnings, a 50% discount to the 5-year average PE ratio. I think the shares rebound fast into the first quarter earnings announcement that could show the bank on stable finances. Southern Copper, ticker SCCO, just barely squeaks in on that money market comparison with a 4.6% dividend yield. I recently highlighted copper as one of the best plays on the rise in electric vehicles. While most investors are watching shares of Tesla or NIO for that electric revolution, the real opportunity could be right here in copper. On projections for 2040, the International Energy Agency estimates the supplies of lithium, copper, and other minerals will need to jump 30-fold to meet demand. The average vehicle on the streets today holds just 51 pounds of copper, less than a third the amount needed for those battery electric vehicles, and just 2/3 the need for a hybrid vehicle. And this chart here shows the current and planned production for those 3 key elements in electric vehicles. Dark blue here is the current operating production, with the light blue including some planned projects. On that red line, the increased demand for EV, we could be in a supply deficit by 2024 in copper, and even earlier in some of these other minerals. Southern Copper has the highest copper reserves in the industry at over 67 million metric tons and is the world's 5th largest producer. In fact, on those reserves, the company has more than 50 years of production left in its mines. And this is a focused producer with assets in Mexico and Peru, and more of a pure play on copper than other miners, with 84% of its revenue from the metal. All this comes together for just a strong revenue growth, price appreciation, and dividend growth for Southern Copper. It's already increased the dividend from just 12 cents to $1 per share over the last 5 years and could have further to grow. We've still got one stock I've held longer than almost any other in my portfolio, but I've got to send that special shout out to all you out there in the Bowtie Nation. Thank you for spending a part of your day to be here. If you're not part of the community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I've held this next stock longer than almost any in my portfolio. Shares of Digital Realty, ticker DLR, with its 5% yield. Digital Realty owns 260 data centers in 40 major cities around the world, so you've got that strong data theme plus some international diversification. All you out there in the nation know I got my start as a commercial real estate analyst. There will always be a special place in my heart for real estate, and I love the safety in property as a hedge against the risk in stocks. That jump in interest rates has hit the sector, though, with real estate investment trusts down 25% last year and 28% for the data center property type. That said, it could be one of your best opportunities for a return. Even after the sell-off, shares of DLR have returned an annualized 16% total return since 2004. That's almost double the 8.5% annualized return on the S&P 500 market. Shares now trade for less than 15 times funds from operations, more than 25% discount to the longer-term average multiple. And demand for data centers is only increasing as we transition into that Internet of Things future, and these properties are going to produce safe and consistent cash flow for investors. Get your weekly Bowtie free with the link below, or click on the video to the right for the 7 dividend kings that will never let you down. 7 stocks that have increased their payouts for 50 plus years. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.